So today I'm going to talk about monetary policy. I hope this video will help you gain an insight in monetary policy and have a brief understanding in the mechanics in monetary policy. To help better understand monetary policy, there are some very simple but important terminology that I would like to introduce. The first one is credit creation, which is also known as deposit creation. This is an amazing fact that when we deposit money into banks, the banks will generate more money. So how do banks do this? I will introduce it step by step. You probably heard of the fractional reserve system where banks are required to keep a certain percentage of total deposit as legal reserve, say 20% in Brazil. A 20% required reserve ratio means that if you deposit £100 into the bank have to retain £20 as reserve and it can only lend out £80. When you go back to the bank to withdraw money, the bank will take the amount from the reserve. However, there is no minimum required reserve in the UK, which means required reserve ratio is 0. Does this mean banks do not keep reserve? The answer is no. The actual reserve is actually around 10%. The difference between the actual reserve and the required reserve is called the excess reserve. So going back to the deposit creation process. When you deposit £100 in the bank will keep only the required reserve in theory, say £20. Then it will lend out the rest, which is £80. We assume the borrowers will deposit the loan into the banks, or maybe other banks. Suppose B is the recipient of this loan. He received £80 and he will redeposit the £80 to bank B. For bank B, the bank will keep 20%, which is £16 as the reserve, and then it will lend out £64. And then the recipient C of this £64 loan will then redeposit the loan to another bank, and the process is repeated. If you sum up all the loans, the amount is £500, which is equal to the initial deposit over the minimum required ratio. We've talked about the creation process for deposit. Now we will consider the contraction process, which is similar. If you withdraw money from the bank will lose reserve and it will have a reserve shortage. The bank will call back loan or sell excess to recover this shortage. Call back loans means the bank will ask their debtors to repay the loan. To repay the loan, debtors will further withdraw deposits from other banks, and then other banks will have a reserve shortage and call back loans. The process repeats until the change in deposit equals the initial change in reserve over the minimum required reserve ratio. Monetary policy is a deliberate action that money authorities would like to control the money supply in order to achieve certain economic growth goals. And this is usually done by adjusting the interest rate. The first one is adjusting required reserve ratio. If the central bank lowers required reserve ratio, banks can keep less reserve in theory. They will then have more money to lend out. In other words, the bank's ability to create deposit increases, therefore the money supply increases. The second tool is called open market operation. This is done by purchase or sale of government bonds by central banks so as to influence money supply. Imagine the central bank purchased government bonds from the market. The recipient of the sum of money is the public. They will deposit the money into their bank account and these raise the excess reserve of banks. When banks have more excess reserve, they tend to make new loans and hence the money supply increases. The third one is by adjusting discount rate. Discount rate is the interest rate charged by central bank on its loans to commercial banks. When the discount rate decreases, the cost of borrowing for commercial banks decreases. This encourages commercial banks to borrow money from central banks, which again increase the excess reserve of banks. Then banks will increase their loans and money supply increase, vice versa. Another tool is controlling the issue of currency. This is simple. If central banks issue more bank notes, the money supply increases and vice versa. So far we've talked about how central banks control the money supply. Now we will talk about how money supply really affects the economy. After the 2008 financial storm, the unemployment rate was high and the economy was in recession. The US central bank had introduced a policy called quantitative easing to boost the economy. In simple words, the US central bank issued more banknotes and increases the money supply. In the diagram, we can see the shift in money supply, which means an increase in money supply will lower the interest rate. If you have any question about the diagram, please feel free to drop me a message. As we can see, when we increase the money supply, the interest rate decreases and the cost of borrowing decreases. The cost for investment and current consumption is actually the interest rate, because if we borrow money to invest, we need to pay the interest rate. On the other hand, if we consume today, we actually give up the chance to deposit the sum of consumption into the bank and earn the interest rate. Therefore, the cost for consumption and investment is the interest rate. When money supply increases, we see that the interest rate decreases, so this boosts the consumption and investment as cost decreases. As consumption and investment are the main component of GDP, increase in money supply will actually boost the GDP. The result for this will be a higher general price level and more employment opportunities. Here we have used an ADAF curve, which describes the relationship between the price level and GDP. We will focus more on the next topic. If you have any question, please feel free to give me a message. I hope you all enjoyed the video, and if you have any question, please feel free to PM me.